Good day, ladies and gentlemen, and welcome to our class on 5 key factors to look at when evaluating share prices, or we can just call this share price evaluation for beginners. Now, many investment strategies use a blend of quantitative and qualitative strategies. They use quant strategies to identify potential investments, and then they use qualitative analysis to take their research efforts to the next level in identifying the final investment. They may also use qualitative insight to select investments and quant data for risk management. While both quantitative and qualitative investment strategies have their proponents and their critics, the strategies do not need to be mutually exclusive. Now, please keep in mind, you have to be aware of what you're evaluating, why you're evaluating it, and what your different reasons for doing this evaluation are. Whether you're looking for a short-term investment, a swing trade, a long-term investment, retirement portfolio, all of this makes a difference. And we'll talk about growth versus value versus risk shortly. But math starts with assumptions. The real world does not work this way. Economics, which calls itself a science, too often doesn't start with looking at the empirical facts in any detail. 15 years ago, even the idea of looking at huge amounts of data did not exist. With a limited amount of data, the chance of a rare event is very low, which gave some economists a false sense of security that long-tail events do not exist. Now, the catch is, in the financial market, everything is correlated. The proof of that is that if the stock market were Gaussian, then you'd never have a flash crash, which, if we've witnessed just recently after the Feds raised rates, we saw the market crash 1,000 points, come back up 1,000 points, and then crash again the next day later. A Gaussian crash would be an event that goes out maybe 5 standard deviations. And this is a rarity on par with 1 in 2 million. In markets, this is simply not true. There are events that are 100 standard deviations. Every economist knows for sure that these rare events occur and cannot be described by a Gaussian function. Now, we do have something that's known as power laws. Power laws are simply a more accurate way to predict what's happening in the market. Because if you don't know the risk, you're not going to make the right decision. And the economy is at risk of these big fluctuations. It's no surprise when they come. The only reason you have to wait a while is because they are rare. Knowing that they will happen forces anyone prudent to have a plan for what to do when it happens. The idea that it would be a power law that describes all these events, the tails in the middle, is really a major contribution. It allows one to quantify risk. And whether you're trading or whether you're investing, risk is the ultimate or the most important factor that you can keep in mind. If you can read off a plot of the law of numerical chance for a downturn in any given size, it's very small for something that is 10 standard deviations out, but not so small for something that is 10 standard deviations out. Now remember, standard deviation is a statistical calculation, and in our world we use the open, the high, the low, and the close, and then we average these from the mean and then determine its variation. So in fact, the S&P 500 fluctuations, which if they were Gaussian, would pretty much be constrained to plus or minus 5 standard deviations. That's over a 10-year period. The number of events that exceed 5 standard deviations is not just 1, it's just 64. And that number that exceeds 10 standard deviations is only 8, and that's over a 10-year period. And there was only one event that exceeded 20 standard deviations. So it looks like the power law. That's what is demonstrated to be when every trade in the stock market is analyzed. So let me tell you a story. 2 of the power to 10 is 10 to 1024. One way to predict the market is to call up 1024 trading places and tell half of them by week's end the market will be up and the other half the market will be down. At the end of the week, forget about the half that knows you were wrong. Keep in mind that for 10 weeks and to the end, you will have called the market correctly for one person who will think you're a genius. So in other words, if you take a group of 100 people, tell 50 of them the market's going to be up, 50 of them the market's going to be down. Well, the 50 that were wrong, you throw away. You just keep the 50 that are right because they all think, God, he made a good choice this week. And then you divide those up and tell 25 of those the market's going to be up and 25 of those the market's going to be down. The ones that are wrong, throw them away. You still have 25 over here that think you're an incredibly smart analyst. So you have 25 left, and you say 12 and a half of those, tell them the market's going to be up, 12 and a half of those, the market's going to be down. The ones that are wrong, you throw away. When you end up with 12 and a half people that swear by you, you're going to be the front page of the Wall Street Journal. You're the front page of the Times. You're the big new financial analyst that everybody's looking to whatever you say. Guess what? Take that next week, and you take 6 of those and 6 of those, and you take the 6 that were wrong, and you end up with 6 guys even now swearing they made millions of dollars on your market calls. At the end of that week, you have 3 by 3. Well, it's a very complex situation, but you can divide it all up and end up being the most important person in the market. Now, there's some easy known evaluation methods to apply to a single stock, but ultimately collecting data is what is key. So how do we decide the true value of a stock? Now, here's where we have to make our decisions. Okay, and I can't make them for you. I don't know anything about you. And every investor, every trader, every person is completely different. But we have to decide what our ultimate personal goal is. Not just, are we looking for investment? Is it for the next 60 days, for the next 90 days? Do we want it to return capital? Do we want it to be safe? Do we want it to be risk-free? Do we want to just pay no attention to it for the next 10 years? No, for a fundamental analyst, the market price of a stock tends to move towards its intrinsic value, which is the true value of a company as calculated by its fundamentals. And this is ultimately important in investing. You have to know and break down that company or that share's price to understand where it stands presently, not where it's going, but is it currently undervalued, overvalued? What is its actual value? If the market value does not match the true value of a company, there's an investment opportunity. Example of this is that if the current market price of a stock is lower than the intrinsic price, the investor should purchase that stock because he expects the stock to rise and move towards its true value. Apparently, if the current market price is above the intrinsic value, the stock is considered overbought, and the investor sells that stock because he knows that the stock price will fail and move closer to the intrinsic value. To determine the true price of the company's stock, there are many factors to consider. Now, if you're watching this class currently, what is one of the things that we could watch, or what is one of the things we see going on in the market? Well, we see Elon Musk trying to buy Twitter. How did he come up with the value of what he should offer to buy and take Twitter private? Okay. Because he's not offering the stock price times how many shares are in the market. He offered a number that he got by coming up with the true value of what Twitter shares are worth. Okay, so, but that's just something to think about. Now, there are alternative types of investment styles that can be applied to individual stocks, as well as different market sectors. Investors commonly criticized according to, or currently categorized according to what investment style they utilize. Now, this is where you're having to make your own decisions. We have value investing. Value investing is an investment style that focuses on buying stocks that are undervalued according to the fundamental analysis and hold that stock until it has reached its true value. Now, the interpretation of value investing can differ from investor to investor. Some value investors observe past and present fundamentals without considering much about the future growth, while others base their strategies completely on the estimation of future growth and forward-looking fundamentals. Now, we haven't come to evaluating stock yet. We're evaluating you and your goals. So are you a value investor or are you a growth investor? Growth investing consists of identifying stocks that have exhibited faster than average earnings growth over the previous few years compared to the market and are furthermore expected to continue to earn growth in the coming future. So one of these things that are tech stocks. And why are we constantly looking at subscriber bases? When we look at Uber, why are we looking at the number of Uber subscribers? When we're looking at Amazon or Walmart, why are we looking at their growth in sales in their online store? We're looking for future growth. Growth stocks are thought to be riskier than average stocks since they usually have high price to earnings ratios and pay little or no dividends to their shareholders. On the other hand, if you pick a good growth stock, it has the possibility of multiplying in value. Investors are thus willing to pay higher share prices for the stock's future growth potential. Now, growth investors seek to make capital gains from a higher share price as opposed, for an example, of receiving dividends payments for income. A growth stock does not pay dividends because the company prefers to reinvest its earnings to keep growing and expanding its business. Now, let me tell you, most of you who come to my classes know I'm pretty up there in years. I'm past retirement. Okay. Now, up until my 50s, I was always looking at growth stocks. Okay. Once I reached 50, or a little bit past, I started slowly moving my portfolio to stocks that paid me dividends because I was going away from my high earning days and now I'm going to need money, cash, to live on because I'm not going to be, by the time I was 65 or 70, earning an income. Unfortunately, we had a horrible event in the 2008, 2009, 2010 market when companies like GE Capital, Bank of America that paid huge dividends, had very little growth in their share value, but it paid huge dividends, stopped declaring dividends. Fortunately, we passed that kind of market. But you have to determine what risk values you want and what you want out of your stocks. Okay, so I became an income investor. Income investors consist of identifying stocks that pay relatively higher regular dividend payments to their shareholders. Well-established income stocks have often had a long history of paying out dividends. So just think, when Bank of America and GE Capital were paying $3 to $5 a year in dividend, and you had a couple thousand shares, okay, if you had 2,000 shares, $5 dividend, you're bringing home a lot of monthly cash. Because as you retire, you need that cash, but you don't want to sell your shares. Your shares are going up in value. You don't want to sell parts of your assets, but you need that income. Okay. So imagine you're buying property not to flip it, but you're buying property for the rental income because you want something that has positive rental income so that you have your spending money in your pockets. Now, ultimately, once you've decided who and what you are, we have 5 key factors to look at in evaluating share prices. Number one is we're always looking at earnings, but earnings can be deceiving. The key element all investors look at is earnings. Before investing in a company, you want to know how much the company is making in profits. Future earnings are a key factor in the future prospect of a company's business and potential growth opportunities. Factors determining earnings of the company such as sales, costs, assets, and liabilities. A simplified view of earnings is earnings per share, EPS. This is a figure for the earnings which denotes the amount of earnings for each outstanding share. Then we want to look at profits because too many people get sucked in to these quarterly reportings or some highlights about somebody released their earnings. Their earnings were phenomenal. But that's not the only thing by itself that's important. The amount of earnings do not tell the full story. Increasing earnings are good, but if the cost increases more than the revenues, then the profit margin is not improving. The profit margin measures how much the company keeps in those earnings out of every dollar of its revenue. This measure is therefore very useful for comparing similar companies within the same industry, because profit margins vary per industry. Now, your tech companies should all be generating the same profit margin, okay? Where your retailers should all be generating the same profit margin or close to it of the other retailers' comparisons. But if you're dealing with an automaker, you need to look at what the other automakers are looking at as far as profit margins. The higher the profit margin indicates the company has better control over its costs than its competitors. Profit margin is displayed in percentages, and a 10% profit margin denotes that the company has a net income of 10 cents for every each dollar of its revenue. To get a better understanding of profit margins, it's good to compare two companies with alternative profit margins. And then we want to go to number 3. And see, none of these stand alone. And too many people get stuck on, oh, I'm going to look at that or I'm going to look at that. But they all tell a story together. Return on an equity. An easy example of this is if a company A and company B both generate net profits of $1 million, but company A has equity of $10 million and company B has equity of $100 million. Their ROE would be 10% and 1% respectively. A is more efficient as it's able to produce the same amount of earnings with 10% less equity. So two companies producing $1 million earning, this company has 10,000 or $100 million out there in investments and factories and stuff. Okay. And they're returning a 10% return on investment. Company B generated the same $1 million profit, but their equity, not their cash in the bank and not their sales and not their earning, but based on the equity that they have, they're only generating a 1% return on investment. Now, ROE is a financial ratio that does not account for the stock price. And that's a nice thing. It's not taking into consideration whether stock shares are up or stock shares are down. It's just telling you what's coming back. Since it ignores the price entirely, it is by many thought of as the most important financial measure. It can basically be thought of as the parent ratio that always needs to be considered. This ratio is a measure of how efficient a company is in generating profits. This is a ratio of revenue and profits to owner's equity. And remember, owner's equity is shareholders. So it's basically return on equity, which is the net income divided by the shareholders' equity. The reason for this measure is so important is because it contains information about several factors, such as leverage or the debt of the company, revenue and profit margins, returning values to shareholders. Good approximation of an ROE should be between 10 to 40%, greater than its peers or its competitors. Number 4 is a number we hear about all the time. For some reason, everybody seems to focus on this like they do on earnings. And this is price to earnings. When taking the current market price into consideration, the most popular ratio is the price to earnings. As the name suggests, it's the current market price divided by its earnings per share. It's an easy way to get a look at the stock's value, but you're using the current market price. The current market price could be up today or down today, having nothing to do with your company. Look, the world collapsed a couple days ago, and the markets collapsed. So you would have a different price to earnings today than you did a week ago, than you did a month ago, even though your company is still doing extremely well. A high PE indicates the stock is priced relatively high to its earnings, and companies with higher PE therefore seem more expensive. However, this measure, as well as other financial ratios, need to be compared to similar companies within the same sector or its own historical PE. This is due to the characteristics in different sectors and changing market conditions. This ratio does not tell the full story since it does not account for growth. Normally, companies with high earnings growth are traded at higher PE values than companies with more moderate growth rates. Accordingly, if the company is growing rapidly and is expected to maintain its growth in the future, this current market price might not seem so expensive. This is the reasoning for the existence of different investment styles. For example, while some sectors normally have low PE measures, other sectors commonly have higher. For example, utility companies have PEs ranging from 5 to 10, while technology companies commonly have PEs ranging from 15 to 20. This is due to expectations of the market, the size of the market, the growth of the market. We don't really expect an energy company to go soaring. Okay, we do expect a technology company to gain significantly. So keep in mind, you do need to be comparing apples to apples. So comparing Apple with GDF Suez won't give you much, because Apple's a huge company with a huge value, with huge growth potential, with huge capitalization, where GDF Suez is from a different market sector, has small growth. It could grow steadily. It could be a great stock for your retirement account. It could be a solid investment. It could actually be thinking about declaring dividends or doubling. But it's a whole difference than comparing it to Apple. So when you compare Apple to Google to Metaverse, then you're at least comparing apples to apples. And lastly, we want to look at price to book. This is something that's not mentioned often. A price to book ratio is used to compare a stock's market value to its book value. It can be calculated as the current price share divided by the book value per share, according to previous financial statements. In a broader sense, it can also be calculated as the total market capitalization of the company divided by all the shareholders' equity. This ratio gives certain ideas of whether you are paying too high a price for the stock, as it notes what would be the residual value if the company went bankrupt today. A higher PB ratio, higher than 1, denotes that the share price is higher than the company's assets would be sold for. The difference indicates what investors think about the future growth of the company. So keep in mind that understanding how to evaluate a stock, understanding what its potential for you is, understanding what type of investor you want to be, understanding how to compare it and classify it to other shares, and how to break down those pieces of information becomes a very important factor, but it's not a formalized factor. Okay? Understanding you, what you're looking for, what the company might be offering, and what the value of that company is today is what makes you a better investor than the guy down the street. So the market's reaction to any type of data is unpredictable. This is not only the case when a news release is in line with analyst expectations, as published by news channels and financial news providers, but also when release data surprises significantly. Sometimes it's not even possible to predict how volatile the market's reaction will be to a release. Sometimes the market will move a range of 50 or more points in response to data. Now, I'll give you an example. Several quarters ago, we were expecting the release from Walmart. All the analysts had put their projections out there, what the revenue was, what the earnings should be. And Walmart missed. It missed earnings, it missed revenue, it missed sales. Now, what would that have told you? That the shares would have tanked. But buried in these pieces of data was one very important piece of information. Their online sales were growing faster than expected. And this is where the company was shifting to its future. And instead of the price of the shares falling, which it did instantly, and that's fine if you're trading, but if you're investing, it fell instantly. But within a couple hours, it regained its losses and steadily climbed, because overall the market was very happy, ecstatic with where the company was growing and their steady growth in online sales. So keep in mind, you have to understand what you're looking at, what the releases mean, what the press releases mean, what you're comparing them to, and who you want to be. Investing in stock isn't as easy as it seems. Okay, and just believing what some numbers tell you isn't just the root of your decision. It's the basics or the starting points of your decision. But figuring out who and what you want to be is ultimately important, and what your risk is and where you fit in the markets. And you can shift, or what you're buying the stock for. Are you buying it for your portfolio? Are you buying it for a short-term investment? Are you buying it for growth? Are you buying it for value? And you don't have to be stuck in a pigeonhole. Like, I no longer invest in anything that isn't income producing. But that's my choice. Period, end. That is my complete choice. I don't want any more risk. I'm too old for risk. Oh, that sounds terrible, doesn't it? But keep in mind, by understanding yourself and what you're looking for, you can become very successful in these markets.